Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Carl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
We encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Welcome to today's podcast. This is Nathan Merrill with Goodspeed Merrill, attorneys at law, and Carl Frank of A&I Wealth Management.
Hi, Nate. How are you?
I am doing good, and I think we've got an interesting topic today. This will probably be a quick one because it's mostly informational. I don't know that we're going to be able to do a lot of analysis here, Carl.
Yeah, who knows?
But just in light of recent events, we thought it would be apropos to discuss the banking system.
I think it's a big deal.
Yeah, in light of, so for those of you who aren't aware, I'll have Carl do a little bit of a recap here. But a couple of weeks back, there was a fairly well-known bank called Silicon Valley Bank in California that was shut down by the regulators in California for fear of a collapse. And then shortly after that, Signature Bank in New York. I think it's been limited to 2 banks at this point, or has there been another one?
No, this is it in America.
Okay. And then, yeah, to your point, in America, and then Credit Suisse merged with UBS in the Swiss banking system, but Credit Suisse, as I understand it, and you can work this into your synopsis, as I understand it, was kind of on the edge for a while in terms of some of their banking practices, their trading desks, that sort of thing, which tend to make them vulnerable. But why don't you give us a quick overview of kind of the Silicon Valley Bank, Signature Bank problem as we understand it today? I know we're a few weeks behind the curve on this, but I think that will give us some good perspective, and rather than just
what's wonderful about being, and I don't know if we're behind because we're going to live with the ramifications of this crisis for a long time. It was a big deal that an A-rated bank was in business on Wednesday and was out of business on Thursday. That's a really big deal. And the way that it went down is a really big deal. It happened, I understand, Colorado has a story in here in that a bunch of the what people sometimes call the PayPal mafia, the very wealthy men, all of them happen to be men, who were a part of PayPal many, many years ago and made their original, hundreds of millions of dollars. As a part of that, got together in Colorado in a ski trip or something along those lines, and decided that, this bank is in trouble. And they had huge amounts of money with this bank, and any amount of money over $250,000, as we all will know now, is not secured by FDIC. And so they pulled out their iPhones and said, transfer everything. And one of the cool things about that bank was its app, was its API, was its ability to electronically transfer money faster than a lot of
it was a tech bank, right? I mean, wasn't that their
Silicon Valley Pay? Yeah, right. It was built around these
VC and it was tech startups.
Exactly, and that was one of their big problems in the end, because they all had the ability to pull out their iPhones and transfer money out right away. And so it was a run on the bank on Thursday, and by Friday they were
describe what a run on the bank is. What does that mean?
So a bank will lend a huge amount of its money that it has, of course. And so if everybody suddenly turns around and says, I want my money out, the bank doesn't actually have all that money. They've lent it out. And so there's too many people requesting their money out at the same time. And so the bank can't provide that. And so the bank shuts its gates.
So the bank has cash assets on hand, which are meant to handle these kind of smaller transactions, but
Right.
that doesn't mean its balance sheet, was it insolvent or just illiquid?
It wasn't insolvent.
Okay.
Yeah. And that's one of the cool, I mean, so there's 2 or 3 things that happened with this. First was that the technology enabled a run on the bank through an iPhone instantly.
Right.
And
their system sent out the money before anybody could say, wait a minute, what's happening
and the
here?
liquidity is not there.
Right.
And this is a huge problem. And then another thing that happened was that they knew they were in somewhat financial trouble. Like this wasn't a surprise to the bankers that they could have this happen to them. And so they tried to issue new stock, and that didn't work. And in this particular year, because of the economy and everything else that's going on in the world, there's not a lot of interest in another stock offering. And so they were already on the watch list. But the unforgivable mistake, before I get to the unforgivable one, is the third one was they had a concentrated risk in a bunch of the same companies who all happen to be of the same crowd. And so these assets grew incredibly fast in the low interest rate world that we have recently. The bank got a huge number of assets. It grew to 200 billion approximately in size, and they all knew each other. And so this very concentrated risk of assets, 88% of the assets they held in the bank were above the FDIC limit of
presumably sophisticated.
All of them.
Depositors, not like your mom and pops and stuff like that. These are people who pay attention to the bank.
Yeah, these are very, very wealthy. These are very, very wealthy VC people and tech entrepreneurs and other people like that. So it's a really big deal. The unforgivable mistake that the bank made was that they put all of their too much of their assets in U.S. Treasuries, long-term U.S. Treasuries, because in years prior to this,
very stable assets.
Interest rates were very low, and so they had to go out into these long-term U.S. Treasuries to even get some sort of a yield on the assets that.
What's long-term, like 10
plus?
Years?
Yeah,
30 years.
10 years plus would be.
And mortgage-backed securities and stuff like that, or
yeah, primarily those is U.S. Treasuries.
Okay.
They didn't even have that risk. Right?
Okay.
These are the safest investments in the world.
Right.
The U.S. Treasury is the safest investment in the world. The shortest term U.S. Treasury is even safer than that. Well, interest rates go up, bond prices go down, and they kept these assets at face value. They didn't keep them at market value.
Got it.
And so they have a run on the bank. They can't sell their treasuries for what they claimed that they were worth, which, by the way, is a common thing among banks. Banks do this all the time. They keep a certain amount of their portfolios in the face value category. Banks are allowed to do this. The rest of the world is not.
Has to mark to market.
Yeah, the rest of us obviously do. And we're a little company. We don't have 200 billion under management, but we absolutely hedged our interest rate risks last year, and we think everybody should do that. And we think it's imprudent of these bankers to do that. And very recently, there's been a lot of investigation going on, according to the Wall Street Journal and other credible sources, that they're now going to, the managers of this bank are likely at fault,
right,
and they're going to be in big trouble. So on Friday, 3 weeks ago, now 3 weeks ago, anyway, at the beginning of March, the regulators came in and shut down the bank, and they claimed that assets over 250,000 would not be honored. Well, they quickly reversed that course because there was huge panic that started to set in.
And the panic was, and maybe you can talk a little bit about what this means, but I believe the fear of quote unquote contagion. And what I understand contagion, or the contagion they're afraid of, is not necessarily that every bank looks like SVB, but it's that large depositors will leave or will do the same thing. Maybe not with their apps and their iPhones, but that they will grab their money and move it to a bank that they feel is more secure. So it would creates kind of a panic, or this, whatever they're calling contagion. So maybe you can talk a little bit about what contagion means.
Yeah, that would be really bad, obviously. And that was really scary because on Thursday, there were lots of people who were concerned that their bank might be at risk. And on Friday, a lot of the banks still hadn't responded about how much risk they might be in. And so everybody was worried about those banks, and a lot of money moved to the handful of banks that have already been declared by the federal government as too big to fail.
Right.
And you know the names: the Bank of America, Chase, and Wells Fargo's on that list. These are the biggest banks.
Not that we support any of these banks.
None of these banks, but they're the banks that had already been declared. So what quickly happened thereafter is the federal government bailed them out. The federal government went in and said, no, we think this bank is too big to fail. And so we're going to honor all of the deposits. And in addition to that, we're going to allow all you other banks out there in the country the ability to borrow money and claim your assets at fair value, at a face value, not fair value. So that, holy cow. So if they all of a sudden need any money, they've got this new lending facility from the Federal Reserve that they never had before, where they can get actual cash in their accounts to pay off anybody who actually wants their money and hopefully stop the contagion. And the effect was that it worked, that the contagion stopped.
So so you kind of just described the intervention that took place. So there was an immediate FDIC action, as I understand it, to essentially stand up and say, we're going to support these. Is it both banks?
Yeah, absolutely.
Yeah. And then the question was, as some of these money movements started happening at other community banks, didn't they, maybe this is the way they extended. They basically said to all these banks, maybe it's not a full guarantee, but
it's a lending facility.
We're going to give you liquidity so that
any bank in the country can now borrow from the Fed.
Has that prevented the money from moving, though?
There is still money moving to the largest banks in the country.
Okay. So too big to fail is becoming more than...
It's an implied guarantee from the federal government that all banks are too big to fail.
All banks.
It's an implied guarantee that all depositors will be secured regardless of the amount of money in their accounts. So it's now a completely different conversation we're having. We're having a conversation about really philosophical things, right? We're having a conversation about, what is there a private banking sector after all? Is it not just the federal
nationalized
government
at this point?
Is it really just a nationalized bank? And if that's the case, why don't we all just borrow directly from the Federal Reserve?
That's right. I can't even go there.
It gets really deep. It gets really profound. And
especially in light of like the Fed digital currency discussions that are taking place.
What kind of a future do we have?
Right.
Yeah, there's another conversation. So yeah, I mean, I think it's really profound. Actually, we should do a podcast on the future of money because there are big ramifications of what that could mean.
So where are we at today? Like 3 weeks later?
Yeah, in the interim, everything's fine. So the market as of today is up positive year to date. It declined temporarily on those declines. We looked at the percentage down for the industry, for the banking only industry, not all financial services, which aren't down nearly as much, but the banking industry is down double digits. But at today's recording, it's in the 12 to 13% down, not nearly as big as what it was right afterwards. As usual, Wall Street says sell first and figure it out later.
Right.
Well, they figured it out since then. Most banks have issued some sort of a press release describing, and we talked about a couple of the companies that have been hit hard and haven't recovered yet. Before the podcast began, we'll leave them out of the conversation. But they've issued press releases that are satisfying their investors largely,
or depositors at the very
and the depositors.
Because that's really who the target on this. I mean, for the most part, is
huge. You got to have the deposits to be a bank.
Yeah.
Without the deposits, you can't be a bank.
Yeah.
I think the other side of this too, though, is that America is by far the world's largest player in the financial markets and in many markets, but it's a worldwide phenomenon. So the banking crisis started here, and then it moved to Europe. And one of the world's oldest, used to be most respected financial institutions, Credit Suisse, fell. And that was a huge crash. It was a much bigger deal for a bank of that size and that history to fall than Silicon Valley, which was like a flash in the pan in the history of the world's finance.
Right, which makes me wonder if that just wasn't opportunism on their part to catch a wave of news and like lump themselves into it. Because did it have any relation to what was going on in the U.S. banking system, or was it more just this? Credit Suisse
they
mismanaged.
No, they absolutely.
And they're like, hey, now's a great time to actually bring this news because it'll get watered out in all the other stuff going on.
They lost so much. I don't think the management at Credit Suisse.
But the timing just happened to be coincidental, or?
No, I think they were at risk. And I think so Credit Suisse has been from scandal to scandal for a decade now. It's been mismanaged almost since the financial crisis. When it was in the financial crisis, the great financial crisis of 2008, Credit Suisse was the shining star.
Right.
It was.
They had one trader that lost like.
Well, Credit Suisse was actually the shining star. Like they were brilliant. They came out of it looking much more strong.
Oh, really?
Yeah. It's easy to confuse them with UBS, who is now the shining star and got Credit Suisse for a song with this
3.2 billion,
which is which is a pittance. It's a 97% loss on what that bank was worth at the beginning, not very long ago anyway, very few months ago, and less than 1% of what it was, or maybe less than 2% of what it was worth at its peak. So yeah, they got it for a song.
That's a great teaser into our next podcast, which is the legacy conversation. How quickly a legacy bank like that can be turned from the most dominant player in the marketplace
to nothing,
to an add-on to another bank.
And to their enemy, to their biggest competitor.
And how families of affluence or legacy families can see the same rapid rate of decline.
Yeah, I mean, it's hard to even, it's really hard, I think, to put that in perspective. So in Switzerland, it's like you're either a dairy farmer or you're a banker. Mm-hmm. Like, I mean, I'm exaggerating, of course, but this is where the money is in Switzerland. This is where the money's made, right? We used to joke in Colorado and Wyoming that if you claim you're a rancher, you're really just an oil man because the money's in the oil, right? And you got the cows as like a tax write-off, right? In Switzerland, it's the same type of thing. The cows are a tax write-off. I mean, it's really all about Geneva, right? It's really all about the banks. Like that's and this is the oldest bank in Switzerland, and this had been the most prestigious bank. And if you think about it, like what we're going to talk about with our legacy conversations coming up, which I'm super excited about, this is a little bit like losing grandpa's money.
Right. Well, that's exactly what it is.
It's a little like I blew it, man. My grandpa built this whole thing, and I went and farted it away in the wind because I'm such an idiot. Mm-hmm. I feel so bad about myself. And I think a lot of people at Credit Suisse are really upset about it.
Yeah.
So there you go. That's the banking crisis. I think the bottom line is that, in politics aside, it is a political decision that was made to save this bank. And it probably, I'm going to argue that it probably didn't need to be made, that even if those assets had been marked to value, there was at least 50 to 60 cents on the dollar for it.
Right.
And the people who would have lost money could probably afford that and still have made payroll. And I think that we live in a world where the Federal Reserve is very active, and the FDIC is very reactive, and the government is very reactive right now. And in that type of a world, there's a lot of instability. And so that's going to continue, right? That instability, those actors are still going to be exceptionally active. And so over a short period of time, expect some instability, but know that the market has already recovered from this. Like your equity markets, what changes now is the range of outcomes that could happen over a short period of time.
What do you mean by that?
That it could get worse, right? And the worseness could be worse than it was before the crisis, right? That other things could start to unravel now. We have a more complicated financial system today than we did in the 2008 crisis. And we saw how an esoteric part of the financial system broke in 2008, something we never heard of before, can bring the world to a screeching halt 15 years ago. Well, it's more complicated now.
Right.
And this was a really simple part of the financial system that broke. So that is a possible thing.
Well,
but it could also get a whole lot better.
Yes. And then the question I have, and maybe this is the closing unanswered question, is does the Fed's action, does the government response, whether you consider the Fed the government or not is open for discussion, but the Fed's response, the government's response in terms of trying to prop up and guarantee, does that inherently change the moral hazard discussion or the risk assessment behavior of banks going forward? Because we all know competition is a real thing. If banks are in competition for profits and the riskier behavior yields the potential for the highest returns, and they know the government's going to backstop them either way, are we pushing banks into riskier behavior? Is the moral hazard our future?
Yeah.
So I'll leave that as the open question.
That's a deep thought. Yeah, let's leave it open. But I think you know where I stand on that. An unqualified, yeah.
But the future is also bright.
Oh, it could be awesome. the future could be incredible.
Yeah.
And so the spectrum of possible outcomes from this are much wider than they were before. And
we're relying on the ethics of individuals at this point to not engage in morally reprehensible risk-taking behavior.
Right. Yeah. And the costs are borne by eventually by the taxpayers.
Yes. Thank goodness I don't pay taxes.
Yeah, good for you. How do you feel about taxes, Nate?
I hate taxes.
Well, I have nothing to add to that.
All right. Well, thank you for joining us today. Hope the panic has subsided. Ours certainly has. And we appreciate you joining us and hope our information has been useful to you. So make it a beautiful day.
Great, beautiful day.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through ANI Financial Services, and securities may be provided through Genios Wealth Management.